All right, Hunter. Well, today we're talking about uncertainty and namely why the markets absolutely hate uncertainty, why recent market actions have led to a lot of uncertainty, from investors, from markets and the economy and how that's trickling through. And I just think it'd be interesting to, have a conversation today for our listeners all about why markets dislike uncertainty and the market dynamics that happen whenever uncertainty increases.
Yeah, that's a great thing to bring up, especially during the recent period we've seen through, tariffs, inflation, just the past few years of different pockets that we've seen of uncertainty. And it's interesting to see how that really washes through the economy from the initial market reaction to, incremental positives as we get more and more clarity as time goes along. Especially again with the tariff situation right now. That's something we've been lacking due to, inconsistent messaging and, just different responses from different countries and really that broad uncertainty of how it's all going to play out. And so, as we're waiting for that clarity, the markets have sold off pretty hard and, just interesting to talk about how we get back to clarity and, what it looks like in the meantime.
Yeah, I mean, uncertainty is derived from, a variety of risks, a lot that would come top of mind, political, geopolitical, regulatory changes, things like economic policy, a lot of it kind of from government down, but then also, underlying things that happen to crop up throughout the economy periodically. You also have things like black swan events. COVID was a great example of that. And then recently, of course, the trade war and tariffs really, injecting a lot of uncertainty into the market. And I think it's interesting because it seems like over the last 5 years, we've had more unprecedented times than precedented times. I think we could all use some precedented times right now. So it's been really interesting just to see how market dynamics have shifted. I mean, if we're just talking about over the last 5 years, as far as periods of uncertainty, first we had COVID, and then we kind of came out of that conundrum, call it by the end of 21. Well, then 22, that was the onset of rate hikes. The Fed really injected what was some level of uncertainty where it was, how high are they going to get with interest rates? When are they going to level out? And then eventually it became in 23 and 24, when are they going to start cutting interest rates? So that led to some uncertainty in the market. The latest big source of uncertainty was first the political elections in 2024 at the end. And now the whole tariff situation and what's going on with international economies. So, we've had plenty of sources of uncertainty. And it's just interesting to see the way that impacts equity prices and just market prices in general.
Yeah, and I think it's interesting to draw the distinction between what we saw with the Fed in 22 and with tariffs now. It's kind of the difference of back in 22, it was a known unknown situation. Is we knew what the issue was. We just didn't know where rates were going to top out, when rate cuts were coming, what was happening with inflation. We knew all the key inputs. It was just there was no way for us to know in advance what that looks like. The tariffs have been a little bit more of an unknown. It's what you don't know that just, springs in from left field. So, a couple of different styles, but really all leads to the same thing. And that's markets are kind of driven from two different directions, both from a mathematical company valuation sense and also a human element. And that from the valuation side is that it's really hard to value companies, specifically their future cash flows, when you don't know what the environment looks like around them. The company itself might be relatively insulated from tariffs or relatively insulated from, interest rates, whatever it is, but they're still going to be affected by the macro around them. And so from that perspective alone is, it makes it really difficult for people like us to do our jobs and really assign a proper value to companies.
Yeah, and you just touched on this, but I think what's so interesting about financial markets and the stock market, for example, is the human element to that. Because at the end of the day, what an asset is really priced at is just what someone else is willing to pay for it. So it's not necessarily, I mean, you and I as market forecasters, strategists, people who do valuation on a regular basis, you can talk about future cash flows, the way that you discount those. And we'll talk a little bit about that during this episode. But at the end of the day, it's that human factor that leads to what someone's willing to pay for another asset. And so if people are uncertain, they're going to kind of lay off to some extent. And then those asset prices are going to come down just from that human kind of element. And I think to put it into kind of a metaphor, I think something that's interesting is like, if you're getting into a car, you want to have the certainty that your seatbelt is going to work. If you happen to get into an accident, you don't necessarily think that that's going to be the case, but you want to know that it works. Well, I think you could also look at uncertainty being injected into the stock market as if you're driving, well, under normal conditions, you don't really expect that you're going to get into an accident. There's less uncertainty. It's a beautiful sunny day. You just expect to drive from point A to point B. Well, now imagine the weather gets really terrible. Maybe it's icy, maybe it's raining. And then all of a sudden uncertainty is injected into that kind of situation. Well, you may feel a little bit more secure in a bigger vehicle, something that's, maybe slower, safer, that's going to be more resilient in the case that you are in some kind of accident, rather than, whipping out your sports car and, hightailing it down the street in the middle of a thunderstorm. Well, that's kind of how financial markets react whenever you inject this uncertainty. It's, hey, I'm going to fly to safer vehicles. I'm going to move more to safer investments. Just because there's that uncertainty out there, I want to make sure that my capital is relatively safe amidst this, unsure environment. Even though everything might just be fine in that sports car, if you were to take off down the road, people are more likely going to kind of pivot into something like an SUV, something that's a little bit more stable, a little bit safer.
Yeah, I really like the analogy because it kind of works for the high flying tech stocks are, a lot more akin to a sports car, a lot sexier, a lot faster moving, a lot more exciting. But when uncertainty comes in, it's the slow, the old reliables that, people like to pivot back towards. And then to just add on to the mathematical portion of this, kind of taking us all back to finance 101, you have a lot of different ways to kind of look at it, but even, your baseline capital asset pricing model, I'm not going to get into the formula, don't worry. But as part of that, there are certain risk premiums that you assign to equity positions over sitting in something like treasuries. And that's really derived by discounting back future cash flows that you project out. Well, if those future cash flows are uncertain, you have to discount them back with a higher discount rate, meaning future cash flows are less valuable to you today because you just don't know if that's going to come to fruition or not. You can also look at it from a, kind of statistics point of view, probability point of view. Well, if there's now only a 70% chance of this cash flow occurring, we need to discount that by 70%. And that's our new cash flow because we just don't know with certainty if that's going to come to fruition. From both sides, I think it's really interesting to talk about both of them because markets are both very mathematical based and formula based. And there's a lot of very smart people in the industry with a lot of great models and a lot of, valuation models, just spending hundreds of millions of dollars just on valuing assets, trying to find the correct ones out there. But at the end of the day, all market participants are also people. And so that's, I think something that either one or the other gets focused on by the media, by, commentators, but it's really both that we have to pay attention to. And it's hard coming from a very, coming out of school, you think everything's very academic, everything's super professional. At the end of the day, these are people making decisions.
Right. And I think that's where you get into what I find very interesting, the behavioral finance, the behavioral economics piece of that. But I think you touched on an important thing is the fundamentals are important during this because they provide a signaling factor that ultimately relies on that human element. But whenever uncertainty is injected, it's not just forecasters that feel less certain about the broader macro environment, it's companies as well. And so if you think about it on a company level, if there's a lot of uncertainty, they don't have, surety of what the, financial environment's going to look like in, 6, 12, 18, 24 months from now, they may look at investments that would normally earn them a higher future rate of return differently than under periods of high uncertainty. So if you're thinking about allocating a huge amount of capital, making a big investment in a new manufacturing plant or something like that, well, if you're not really certain of how the market's going to look, in 24 months from now, you may hold off on that investment. And that's what we're seeing with a lot of the tariff impact right now. Of course, we have podcasts, and we're going to continue doing podcasts that really dive into the specifics as far as tariff related uncertainty. But just looking at the broad impacts of uncertainty in the market, it definitely impacts company investment. It impacts hiring. Are you going to continue to hire people if you don't know what the economy is going to look like 12 months from now? You're probably not going to hire as many if it's looking a little bit sketchy. So having some certainty of what the future is going to look like both means a lot to forecasters, market participants, but it also means a lot to the companies that are, driving the actual value for these companies in the first place. And that's through the investments that they're making, research and development, hiring, growing their market share.
Yeah, that's where I'll reiterate something that I kind of touched on earlier with an unknown unknowns in tariff policy, is that because this is all self-imposed, it's not only the magnitude of tariffs that we don't know. I call that kind of a more known unknown. Is we know tariffs are here. How high are they going to go? How high are they going to stay with, whatever negotiations go on? Any potential challenge to that through Congress or the judiciary. But there's also the, self-imposed aspect of it of, with a tweet, it could all go away. It could change materially with any kind of new breeze of the wind. So that's it's a twofold thing. Is tariffs are high now, but some investors are pulling back entirely. Some are continuing on with their business plans because, they don't see that it has the staying power. I think it's just interesting to hear from both sides of the coin. It's hard for people to really expand, but people who've been working on things for years don't really want to close up shop immediately because there's not that broad market, expectation that these are going to last in a durable form for the next several years.
Right. And I think you made that point perfectly, is that what the market's looking for is some certainty as far as tariff policy, whether it's favorable to the marketplace or maybe slightly unfavorable. Still, some surety in that would go a long way in helping, shore up equity prices, shore up the stock market in general. Because, you touched on this earlier, but investors are going to demand higher returns when there's higher uncertainty. That's what's led to this big price pullback, is that, if you're really not certain, you got to start at a lower base, because if your, forward return was only looking like, call it mid-single digits before in equity markets, that's not, you're taking on too much risk all of a sudden to be getting that kind of return. Now you got to rebase that, start off from a lower level and say, hey, maybe my return over 12, 24 months is looking like double digits or better than that potentially if I'm going to take on this excess risk. And we touched on this before too, but that's why you've seen investors flying to the bond market, flying to other alternative asset classes, cash. I mean, that's a whole dynamic that's playing into this right now. The fact that the Fed funds rate is still, north of 4%, and many money markets are yielding right around 4%. It makes it an attractive option for investors to fly into that. We've talked about historically that wasn't always an option. So it's been interesting to see that dynamic. Although I will kind of caveat this with the fact that we've actually seen mostly retail buying over this period. And I know we're kind of, getting a little bit on a tangent here as far as the market kind of mentality, but it's really interesting to see retail investors because they're not, building out these extensive cash flow models. They're not, they don't have 20-year history of, economic forecasting and things like that. They're looking at, hey, who's been rewarded in periods in recent history where we've seen market downturns? Well, those that continue allocating capital. And that's, of course, something that we would, preach as investment advisors, investment managers, is that it's always a good time to invest. Hey, we've seen a market pullback. Yeah, if you're a long-term investor, then you shouldn't be worried about the next 12 months anyway. So why not allocate at a period like this? If you are worried about the next 6-12 months, sure. Yeah, I understand being on the sideline, but that's where the market mentality gets into this. And it's created some really interesting dynamics.
Something that we say around the office a lot really relates to this is, if you liked NVIDIA at $140 a share, you must really like it at 100 or 110. And so it is that kind of like twofold thing where, yes, you demand much higher risk adjusted returns, but also being able to have a long-term time horizon makes these companies really feel more like a sale than it does a big issue. If you're going to be day trading or a really short time horizon, then absolutely those money markets, get your 4%, be happy, no volatility. Longer term time horizons, we can start looking at this as more of a buying opportunity than anything else. And I think that's something that, like you said, retail has really done. And I've seen I think there's a little bit of almost disdain in the, financial journalism world for the retail investor. They're viewed as very, uninformed, very just kind of unintelligent people putting money behind meme stocks or whatever. But we do have to lend them a little credit in that they're keeping that long-term perspective. They're seeing that the companies that they really liked, last year at huge valuations be considerably less expensive, and looking at it as a time to, stomach the volatility, put your money here and just let it go, because these are also, the same people that they're talking about playing with options all over the place, and the meme stocks like I referenced, there are people who can stomach volatility. And so being able to just look through it, look to the future, can provide some opportunity when, asset prices become so depressed. I'm not saying this is a bottom, but it's, eventually markets have rebounded and reached new all-time highs. So it's an interesting thing to watch, and, we can't totally write off that mentality.
And I think what you're just saying brought me to a pretty interesting data point that I saw recently. I'm sure I've mentioned it on previous podcasts, but a lot of times uncertainty goes hand in hand with market sentiment. And when uncertainty is high, market sentiment can tend to get extremely low. And we've seen that in a lot of the recent consumer sentiment reports. Now, whether if some of that's politically driven or not, that's up for another conversation. But we have seen, economic confidence, consumer confidence really drop off to a large extent. Well, some of the best return periods in history are when sentiment is at its lowest, because typically that means equity positioning is relatively low. People are afraid, they're out of the stock market. Well, where are they going to go from there? They're going to go back in. And so that may take a period of time. Like you said, it goes back to the long-term perspective and why we believe that's critically important if you're an investor. And that's why we always say at Beck Capital Management, we're investors, we're not traders. We'll try to make tactical decisions as best as we can see them, given what's going on with the macro or on the company specific basis. But fundamentally, at the end of the day, you're a long-term investor. You're investing in these companies. You believe in what they're doing. And that's why we buy predominantly individual companies, is because you have ownership in that specific business. It's not just some kind of blanket obscure thing like the S&P 500 where you've got a little piece of a whole bunch of companies. You're believing in the future profitability, cash flows, prospects of those individual companies. And that kind of gets me to this next point, is some things that investors can do during these uncertain times. Well, a lot of it's in the preparation, and that's just maintaining, some kind of diversification. You and I just released a podcast where we're preaching on kind of fixed return investments and why those might be really good for 2025. Well, having a core portion of your portfolio in investments like that, structured notes, private or public real estate, things like, some types of fixed income, and the like, maybe private credit, can provide that kind of, more certainty as far as future cash flows go, rather than the equity market. So having a piece of your portfolio in that, and then maintaining your, 12-month plus outlook for your equity allocation. And so I think that's at least kind of one of those first steps that someone can take to preparing for uncertain times.
Yeah. And I want to touch on one thing real quick as far as the preparing, and then get to something that you said, because I think that's really interesting and really timely here. But is, one final thing being having some cash reserves on hand, whether that's for tactical investing, but we see it in our business predominantly with retirees, people who are drawing down on their investment accounts in retirement. Have something that it doesn't even have to be cash, but something with a very low beta or low correlation to the market, where during a downtime like this, you're not having to sell the companies you really like, that you really believe in, at depressed valuations just to sustain your lifestyle. Have your short-term spending money in either cash equivalent, some kind of really conservative instrument that's highly liquid, and then have your longer term horizon that will allow you to not only avoid that selling at depressed prices, but maintain that long-term investment outlook like we talk about with your investments, without worrying about how you're going to pay your credit card next month because your Nvidia shares sold off 10%. And then to go back to your point about that podcast that we did on all those kind of fixed return investments, now is such an interesting time for all of that, because the uncertainty is not only points you in that direction, just out of your own capital preservation or, just kind of reducing risk, but actually higher volatility in the markets helps those investments directly. A lot of these are based on or have options as a component to them. Structured notes are essentially baskets of options. Those defined parameter investments are, have options attached to them. A lot of those kinds of things are actually priced better during periods of high volatility. So it's periods like this that you can actually get the best return off of those investments. So it's really creates a great environment for pivoting to some of that. And another time where it's nice to have cash on hand, so you're not having to sell equities to fund the purchases of those, but being able to lock in higher rates of return in some of these investments that are much more fixed just because there's higher volatility in equity markets.
Absolutely. I think that's a really important point. It goes along with this whole conversation that we've been having, because another thing to keep in mind too, as we kind of conclude this episode and kind of wrap up for our listeners, is that the market is forward looking. So a lot of times whenever you reach peak uncertainty, it's because future economic situations potentially going to be bad. And that's why equity or market prices drop. Well, it's not because that bad economic situation has already come to fruition. It's that it's looming on the horizon. Well, a lot of times equity markets bottom a lot earlier than the economy does. So you may see the worst earnings come out several months after the financial markets actually bottom, just because the market is so forward looking. So I think it's important to take it into account that when uncertainty is at its highest, which kind of feels like the current environment that we're in, because there's a lot up in the air about tariff policy, about trade deals, about what's going to happen, on a go forward basis, uncertainty is extremely high. Well, a lot of times that's when the market has really sold off to a greater extent. Now we're going to have to keep, following the situation, seeing what's happening, especially with this tariff and trade situation. And we'll continue to release podcasts on that. But I think it's important to realize that, hey, the market's forward looking. It may actually bottom before the economy actually does.
Absolutely. That's a great point. And I really find a lot of almost comfort, you can call it, but kind of reassurance too, in all of these contra indicators, like markets bottoming before, economics do. Like you mentioned, the market sentiment being depressed. Well, that leads to some of the highest equity market returns from low levels of market sentiment. And also, I saw a stat the other day, because the VIX, it's a volatility index, was, peaked at 50 or over 50. And that is very high for it. And it never stays up there for very long. But just to get to that level is really exceptional. But 96% of the time, it reaches a level that we saw, in the last couple of weeks. Equity markets have been higher the following year, which is kind of, it's another just contraindicator. It's kind of wild to think about that you have this period of such violent uncertainty and, volatility in markets, and 96% of the time markets are higher than following year because they're forward looking, because markets are always looking at the horizon, looking through what's going on right now and trying to find some signal to the noise. And generally 96% of the time they find a way through.
Absolutely. I think you worded that perfectly. And just as kind of a parting thought for our listeners, as we mentioned, if you're an investor, think about it for the long term. If you have a cash need within the next 12 months, allocate appropriately, talk to your financial advisor about that. But keep a cool head whenever there's great uncertainty in the market, because while the market doesn't like uncertainty, that doesn't mean you have to overreact to it and, be hurt by making a rash decision. So keeping a cool head, sticking to the long term, working with somebody who can help you with your financial goals, I think that'll have anybody pretty well positioned for the long haul.
Yeah, great point, Victor. Thanks.
Thanks.